Hello, everybody. While the main focus these days is on the FOMC meeting tomorrow, Wednesday, I thought it is also appropriate to have a look at what is going on in the Eurozone. If we look at the monetary policy in the Eurozone, it's been clear that the ECB's quantitative easing program really has worked. Since early 2015, monetary conditions in the Eurozone has been pretty stable. We have seen continued recovery in the Eurozone, and if we look at our own indicator for medium-term inflation outlook, our monetary indicator for the Eurozone, it has been close to zero from early 2015, indicating that inflation was on the way to hit the ECB's inflation target of 2% in medium term. However, in recent months, or more essentially from the fourth quarter of 2017, our monetary indicator has dropped quite a bit. The monetary indicator is constructed so that it gives us an idea about medium-term inflation outlook. It doesn't tell us anything about what's going on in the near term, but it tells us something about where inflation will be heading in, let's say, 2-3 years. The indicator is a composite indicator. It's 4 sub-indicators constructed by adding up 4 sub-indicators. It's the money supply growth or broad money. In the case of the Eurozone, the M3 growth. It's nominal demand, or in the case of the Eurozone, nominal GDP growth. And then we look at the exchange rate developments and interest rate developments. We add these 4 indicators up to one monetary indicator. And that indicator is essentially calibrated such as when the indicator is 0, we will be heading towards 2% inflation in the case of the Eurozone. And as I said, the indicator has been close to 0 since 2015. Mario Draghi really has been able to re-anchor inflation expectations close to 2% and done a quite good job in recent years. However, we have seen 2 things happening in the last couple of quarters, which is somewhat alarming and should give the ECB reason to rethink monetary policy, or at least worry somewhat more about downward inflationary risk. First of all, if we look at money supply growth have slowed, both if we look at narrow money M1 growth, and if we look at the broader money supply growth M3, both have slowed quite significantly in recent months after the ECB has started to taper in terms of money-based growth. So clearly the tapering is causing money supply growth to slow down in somewhat alarming fashion in our view. And if you look at the M3 growth rate, it's clearly below what we consider to be consistent with the 2% inflation target. What we call the policy consistent growth rate of M3 is somewhat higher than what we're presently seeing. And if we made a similar measure for M1, it would show the same thing. So clearly, money supply numbers are indicating that monetary policy is becoming too tight in the Eurozone. Similar, if we look at the development in the Euro, the strengthening of the Euro, clearly it's excessive compared to hitting the 2% inflation target, and essentially we shouldn't see any strengthening of the euro in nominal terms, but we have been seeing that over the last year. So that as well is adding to lowering our monetary indicator, which now has dropped significant below 0. And if there isn't any counter reaction in terms of the ECB stepping back and easing its rhetoric or softening its rhetoric, then we are likely to have a quite significant continued undershooting of the ECB's 2% inflation target. What we do assume in our inflation target is that the ECB to some extent will turn around. But if they don't do that, we are likely to see inflation remaining significantly below the 2% inflation target also in the medium term. And the question is, When will the market start to worry about this? So far, the markets are relatively unworried about the tightening of Eurozone monetary conditions, maybe because Eurozone cyclical indicators have been positive so far. But if cyclical indicators start to turn down as well, it might also cause more worries about nominal demand growth in the medium term. And that, I believe, could also cause increased worry about the Eurozone in general. And we might see the return of the kind of jitters we have seen since 2008 from time to time. So the ECB really should be very careful in the present situation and shouldn't be overly focused on the cyclical upturn, but rather should be worried, I would say very worried, that we're seeing a renewed de-anchoring of inflation expectations, and they could continue to drop if the ECB does not soften the rhetoric. Of course, the problem for the ECB is that cyclical indicators have been relatively strong, and the Federal Reserve is tightening monetary policy. But that's because the US economy is in a completely different state than the Eurozone economy. Yes, the cyclical pattern has been the same, but in terms of inflation expectations, we're seeing a de-anchoring, and monetary indicators really is saying to us right now that inflation risk is really to the downside in the Eurozone. So the ECB shouldn't be talking about hiking rates. In fact, the ECB should come out and stress that it could reintroduce or step up quantitative easing if necessary to curb these increasingly deflationary pressures that we're seeing in the Eurozone. We're not yet in a situation where we're going back to a full-blown Euro crisis, and certainly don't hope we will get there, but monetary indicators are not too positive at the moment, and we clearly see downward inflationary risk in the Eurozone. So Mario Draghi, you better tell the Germans that if this continues, we will have renewed Eurozone jitters, renewed Eurozone volatility, and we don't want to go back to 2011, 2012 again. It's about time the ECB reassess the situation. The risk is not for an upside surprise on inflation. It's clearly for continued downward surprises on inflation, and therefore also we could start to talk about Eurozone crisis once again if the ECB is not very careful going forward.